The account balance reads $4,211.07. It was $47,000 6 months ago. You know exactly what happened. That's the part no one prepares you for. Not the loss itself, but the clarity that arrives after. The perfect, humiliating hindsight. You can trace every step. The October trade you held 2 weeks too long. The Tesla puts you bought because a Reddit thread had 14,000 upvotes. The $8,400 you moved into a biotech stock the same week the FDA announcement came. You weren't being reckless. That's what you told yourself. You were being strategic, calculated. You had done the research. The research that cost you $42,789 in 7 months. And the strangest part, the part that should disturb you more than it does, is that you would probably do it again. Right now, if the screen showed the right number, you would move. Because your brain isn't broken. It's working as designed. The problem is what it was designed for. Go back 14 months. You're sitting at a different desk, in a different financial reality, and the number you're looking at is $50,200. That's what you've saved over 3 years of disciplined living. Packed lunches. A 2014 Honda Civic with 112,000 miles on it. Vacations canceled, drinks skipped, streaming services consolidated down to one. You built that number through actual sacrifice, not inherited, not lucky, not leveraged. And when you look at it in your brokerage account, mostly sitting in a Vanguard S&P 500 index fund, boring and steady, you feel something close to pride. The slow kind. The kind that comes from patience rather than brilliance. You've been watching the market for about a year now. Reading, learning. You follow 3 finance accounts on YouTube, 2 newsletters, and a Substack that explains options chains with what feels like uncommon clarity. You know the difference between a covered call and a naked put. You understand what a price-to-earnings ratio means and why a high one might signal overvaluation or might signal growth expectations, depending on the sector. You've absorbed the language so deeply that you occasionally use it in casual conversation without noticing. You're not a beginner anymore. That's what you believe. What you don't know yet is that knowledge and decision-making are 2 completely different cognitive systems, and they are about to collide in a way that will cost you 3 years of your life. The first sign arrives quietly, the way most important things do. A colleague at work, someone you don't even particularly like, someone you find slightly insufferable at team meetings, mentions over coffee that he bought NVDA at $180 and it's now sitting at $290. He says it casually, like he's reporting the temperature outside. He doesn't know you're watching his face, cataloging the specific texture of his confidence, the way he shrugs as if $22,000 in unrealized gains is just something that happens to a person who paid attention. You go home that night and pull up your own portfolio. Everything is green, modestly, steadily green, up 11.3% over the last 14 months. On paper, that's a good year. Better than a savings account. Better than the CD your parents would have recommended. Better than almost anything your grandparents would recognize as investing. But it's not $22,000 in 6 months. You don't make a move yet. That matters. The first step isn't the trade. The first step is a feeling. A specific, almost physical sensation of being left behind by someone who deserved to be left behind less than you. Economists have a name for it. Relative deprivation. Your brain doesn't evaluate what you have in absolute terms. It evaluates what you have compared to the person next to you. And right now, the person next to you has more. Much more. And he got it effortlessly, or so it appeared, while you were carefully, responsibly doing everything right. This is where it starts. Not in the market. In your mind. 3 weeks later, you put $6,000 into NVDA. You've done the analysis. Revenue growth of 122% year over year. Data center expansion accelerating. AI infrastructure tailwinds that every serious analyst is calling a decade-long cycle. Every metric you can find confirms what you already wanted to do. You notice, somewhere in the back of your thoughts, a small voice observing that you wanted to make this trade before you looked at the metrics. But that voice doesn't get long. There's too much signal coming in, too much conviction building, too much to review and discuss with yourself. The small voice doesn't have room. The stock goes up 8% in 11 days. This is the most dangerous thing that can happen to a new investor. Not a loss, a win. Because what your brain records in that moment is not, I made a trade that worked out. What your brain records is, I was right. And being right feels completely different than being lucky. It feels like competence. Like confirmation that the research process worked, the analytical framework worked, that you work, that the version of you who stayed up late reading earnings transcripts is better at this than the version who just held the index fund and watched TV. Your prefrontal cortex, the part responsible for long-term planning, probabilistic thinking, and rational evaluation of evidence, gets quietly bypassed. The limbic system, older by millions of years, faster, built for pattern recognition and reward feedback loops, takes a small but significant step toward the steering wheel. You add another $4,000 the following week. You've probably done this. Most people have. It doesn't feel like escalation from the inside. It feels like confidence, which is the thing confidence and escalation have in common. The position grows, $11,400, then $13,800, then, over the next 6 weeks, to $17,200. You are up 43% on your initial entry. You screenshot the portfolio balance. You don't send it to anyone, you're not that person, but you save it. You look at it sometimes before bed, the way other people check the weather before sleep. Something about it settles you. This is the number that changes everything, $17,200. Not because of what it is, but because of what it teaches your brain. Because now your brain has recorded a lesson it will not easily unlearn. Concentration beats diversification. Conviction beats patience. You can see things in a company's fundamentals that the market hasn't fully priced in yet. None of that is true, but your brain has evidence to prove it. And in the architecture of human cognition, felt evidence is the most powerful kind there is. What you don't know yet is what that belief will cost you. 6 weeks after the NVDA peak, the position corrects. Standard sector rotation, analysts say later. Nothing dramatic, nothing structural. The stock pulls back 18% over 3 weeks as institutional money rotates toward defensive positions ahead of a Fed meeting. Your $17,200 position drops to $14,100 and stays there. You don't sell. This is the second hardest thing to explain to someone who hasn't lived it. The position is still profitable. You're up significantly from your cost basis. Selling now would lock in a real gain. Not a paper one, a real one, cash in your account. But selling now also means admitting that the run might be over. It means converting a future number into a present one. And somehow, irrationally, precisely, the future number feels more real than the present one. The number your brain keeps returning to isn't $14,100, it's $17,200, because $17,200 is what you had. Loss aversion. The research on this goes back to Kahneman and Tversky in 1979. The brain weights a loss approximately twice as heavily as an equivalent gain. Losing $3,100 feels roughly twice as bad as gaining $3,100 feels good, so you hold. Because selling feels like loss. Because your brain has classified the fall from $17,200 to $14,100 as a loss you haven't yet been forced to acknowledge. And as long as you don't sell, you don't have to acknowledge it. You tell yourself you believe in the long-term thesis. You probably do. But the thesis isn't why you're holding. 2 months pass. The stock recovers partially. It's at $15,900 now, still below your peak but moving. You've been reading in the interim. Deep reading, serious reading, and you've landed on a conviction that your initial position was actually undersized. Real wealth isn't built by spreading risk thin, you've read and reread. It's built by betting heavily on what you genuinely understand. Buffett, Munger, concentrated portfolios. You've done the work. You move $8,000 out of the index fund, the boring, steady 11% annual return index fund, and into NVDA. Your position is now $23,900 combined. 6 weeks later, the stock drops 31% across 9 trading days, and earnings miss. Guidance revised downward. Competitive pressure from a new entrant in the data center market. The words in the analyst notes blur together. What doesn't blur is the number. $23,900 has become $16,500. You've lost $7,400 in 9 days. You hold. Because selling at $16,500 means acknowledging that $20,900 is gone. There's a cognitive bias called the sunk cost fallacy. You've heard of it. You could define it accurately. You could explain it to a stranger with precision and some appropriate nuance about when it's a fallacy versus when sunk costs genuinely carry relevant information. That's what makes what happens next so quietly devastating. Understanding a bias does not protect you from it. This is the thing the behavioral finance books don't say clearly enough. Knowing that the sunk cost fallacy exists, being able to name it, trace its history, recognize its signature in other people's decisions. None of that creates usable distance between you and the moment when $69,500 feels wrong to sell because you remember $23,900. Your prefrontal cortex can name the bias. It can even apply the name in real time, watching yourself fall into it, narrating the process with uncomfortable accuracy. Your limbic system doesn't care about names. It cares about the feeling of loss. It cares about the number it peaked at, which it has stored with more fidelity than any of your analytical conclusions. The stock drops further, $12,800. You look at it every morning, before coffee, the phone face up on the nightstand before you're fully awake. You stop talking about investing at work. When your colleague mentions his portfolio, you deflect, change the subject, ask about something unrelated to money. The public version of your financial life and the private version are now two separate realities, and maintaining the gap between them has a cost, not a financial one, something harder to value. You start checking the app at 2 a.m., not to trade, just to look, as if looking often enough might change what you're looking at, as if attention alone has protective power over a position. This is when the cost stops being only financial. 4 months in from your peak position, your original $51,200 is now approximately $29,600. You've lost $21,600. Not all from the single position. You've rotated money across several trades by now, moving out of losing positions into new ones, trying to recover losses with gains from different plays, which is one of the most reliably destructive patterns in retail investing. Each new trade feels like a reset, a clean thesis, a fresh entry point unencumbered by the previous mistakes. You are not gambling, you are always analyzing. The analyzing is the problem. Here's what no one tells you about overconfidence in investing. It doesn't look like arrogance from the inside. It looks like diligence. It looks like staying late to read 10K filings. It looks like building comparison spreadsheets for competitors in the same sector. It looks like caring more and working harder than the average retail investor. The very behaviors that feel like discipline are functioning as cover for a brain that has decided it can consistently outsmart a market built and maintained by people who have been doing this professionally for decades, using algorithms that process satellite imagery data of Walmart parking lots to forecast earnings 3 weeks before the report drops. You have a Dell laptop and a Fidelity account. But your brain cannot model this asymmetry accurately. It is structurally incapable of internalizing just how comprehensively outmatched it is, because doing so would require a level of epistemic humility that conflicts with the confidence required to place a trade. You can't act and radically doubt yourself simultaneously. The brain resolves this conflict by suppressing the doubt and elevating the signal. Every time you execute an order, somewhere in your neurology, the doubt has been quieted just enough. 6 weeks later, same chair, different problem. The portfolio is at $21,400. You've lost more than half of what took 3 years to build, 58% of your savings, and somewhere in the middle of the night, lying awake in that specific 3 a.m. silence, a thought arrives that you've been avoiding for months. Maybe you're the problem, not the picks, not the timing, not the bad luck of an earnings miss or a macro rotation. The you who chose the picks. The you who held through losses and doubled down on conviction. The you who checked the app at 2 a.m. as if watching the number was the same as managing the risk. That thought has a cost too. For 2 weeks after it arrives, you don't trade. You sit with the portfolio, watching it move, up 1.2% one day, down 0.8% the next. In patterns you no longer feel entitled to interpret. This is actually the most financially intelligent thing you've done in months. But it doesn't feel intelligent. It feels like paralysis, like failure. The version of you that had conviction was doing something. This version is just watching. And your brain, which has spent 14 months learning that action is competence, finds inaction almost physically uncomfortable. Identity is more expensive than people realize, and you've built one carefully, without meaning to, the way most identities form. Through small daily decisions that accumulate into something you can no longer see clearly because you're standing inside it. Think about the compound effect of the past 9 months in terms that aren't financial. You spent hours reading, you built spreadsheets, you had opinions, you tracked earnings calendars and flagged Fed meeting dates, and knew which consumer sentiment indicators historically predicted sector rotations. You were someone who knew things. Someone who worked at understanding a system that most people just passively participated in. That felt like an identity worth having. More than that, it felt like an identity that justified the late nights, the anxiety, the $38,000 in losses. People who build expertise are supposed to eventually be rewarded for it. The market doesn't reward effort, it rewards accuracy. Those are different things. You built a story about yourself as someone who understood the market, someone who had done the work, absorbed the language, developed real analytical judgment. Losing money on individual trades was explicable. The market goes against everyone sometimes. But losing the story, becoming someone who fundamentally didn't know what they were doing, someone who would have been better off doing nothing, that's a different category of loss. And your brain, which is deeply in the business of protecting self-concept, will do extraordinary things to avoid that reckoning. So you find a new framework. Value investing, deep research, the patient, Buffett-style approach that the previous momentum-chasing phase wasn't. You spend 2 weeks reading everything you can find. You feel the familiar sensation of conviction reforming, solidifying, becoming an asset again. You find a small-cap pharmaceutical company, revenue growing 67% year over year. A pipeline of 3 drugs in phase 2 trials, 2 of which address large unmet markets. Trading at what your discounted cash flow model, which you've built yourself carefully, suggests is a 40% discount to intrinsic value. This time, you've done the real work. You're not chasing momentum. You're not reacting to a colleague's casual brag. You put $9,000 into the position and feel something you haven't felt in a while. Calm. The specific calm of someone who believes they are right. The company announces a phase 3 clinical trial failure 6 weeks later. The primary endpoint was not met. The stock falls 58% before lunch on the announcement day. Halt. Resume. Halt again. By close, it's down 61%. Your $9,000 is worth $3,510. The next morning, you sit in your car in the parking structure at work for 22 minutes. Not crying. Not on the phone. Not doing anything visible. Just sitting with your hands in your lap, engine off, looking at the concrete wall in front of you. $47,000 has become $13,200. 9 months. $37,800 gone. What the math shows you, slowly, over days, is the specific shape of what happened. There was no crash, no black swan event that wiped out everyone equally. No systemic fraud, no once-in-a-generation market collapse. The S&P 500 returned 14.7% over the same period. The boring, steady, no-thesis Vanguard index fund you pulled money out of to make these trades returned 14.7%. If you had done nothing, if you had left $51,200 in the index fund and gone for walks instead of reading earnings transcripts, you would have $58,576 right now. The cost of your effort was $45,376. The active, research-driven, conviction-based version of you destroyed $45,376 in value compared to the passive, do-nothing version. Your brain, operating at what felt like peak capacity, fully engaged, fully committed, fully serious, was the most expensive thing in the room. This is not a story about bad luck. The research on this goes back decades, and it does not waver. In 2000, behavioral economists Brad Barber and Terence O'Dean analyzed 66,465 household brokerage accounts over 5 years. The average household earned a gross return of 18.7% annually. The market returned 17.9%. Before trading costs, the average investor was slightly ahead. After trading costs, commissions, spreads, timing drag, the average household's net return was 16.4%. The market beat them by 1.5 percentage points every year just through the friction of activity. The more they traded, the worse it got. The most active quintile of traders underperformed the market by 6.5% per year. Your brain cannot accept this cleanly. Not because you're unintelligent. The study found no correlation between education level and trading performance, because the brain is built to believe that effort produces results, that more information leads to better decisions, that the feeling of understanding something is roughly correlated with actually understanding it. That pattern recognition, applied diligently enough, becomes an edge. These are mostly accurate beliefs. They're why you learn to drive, to cook, to do your job. They're why effort generally works. Financial markets are one of the few systems where these beliefs systematically reverse, where doing more frequently produces less, where the feeling of certainty is negatively correlated with accuracy, where the most dangerous thing you can possess is a compelling narrative about why a specific stock will outperform. And your brain is a narrative-generating machine. It never stops. Even now, with $13,200 on the screen, it's already constructing the comeback thesis. You go back to the index fund. Not dramatically. Not with catharsis or resolution or the clean feeling of a lesson learned. On a Tuesday afternoon, you move $13,200 into the Vanguard Total Market ETF. No position, no thesis, no conviction. You set up an automatic $400 monthly contribution. You turn off the app notifications. You delete the 3 Reddit communities you'd been reading. The first week, you check the account 4 times a day. The second week, twice a day. By the third week, you've stopped looking at individual holdings. You look only at the total. You try not to do the math on what you lost. Some nights you do the math anyway. And what the math shows you, slowly, over months, in a way that doesn't announce itself but accumulates, is something you couldn't have been told in advance. The index moves. Not dramatically. Up 0.4% one week, flat the next, down 1.1% the week after that, then up 2.2%, then flat for 2 weeks, then up again. The rhythm is almost meditative in its indifference to your attention. It is boring in a way that is almost physically uncomfortable, because your brain still generates stories, still notices that one sector is running, still feels the pull when your colleague mentions, casually over coffee, a new semiconductor play he's been watching. Same shrug, same texture of confidence, same invitation. You nod. You say you'll look into it. You don't look into it, not because you've achieved some higher state of investor discipline, not because you've become someone who is immune to the feeling of being left behind, but because $37,800 is a different kind of teacher than any book or framework. It doesn't lecture. It doesn't summarize itself. It just sits, quietly, at the edge of every moment when your brain starts building a new story about a trade you could make. And it waits there, patient and permanent, for you to notice it. 14 months from where this started, the account reads $23,140. You've contributed $6,800 in monthly additions. The index has returned 9.3% since you re-entered. You are not whole. You will not be whole for years. 3 more years of $400 monthly contributions, assuming 9% annual returns, to get back to where you would have been if you'd done nothing at all. The math on that is its own kind of quiet. 3 years of sacrifice, then 9 months of effort, then 3 more years of recovery, all because your brain did exactly what it was built to do. You look at the account one more time tonight, $23,140. The contribution scheduled for Friday. The allocation, 100% total market index. No individual positions, no thesis, no conviction. You close the laptop. Outside, the market closed 2 hours ago. In 12 hours, it will open again, indifferent and enormous and continuous, processing 4 billion trades today as it did yesterday. Built by people who understand your psychology better than you do, who modeled the way your loss aversion creates predictable sell patterns, who have made careers out of being on the other side of the trades that feel most certain. The market does not know you exist. It never did. The number on the screen is accurate. The contributions are automatic. The strategy requires nothing from you, except the willingness to do less than your brain wants to do, which turns out to be the hardest financial discipline there is. You were not the protagonist of a market story. You were the market's liquidity.